Over the last 30 weeks, the S&P 500 has posted a record 30% gain. That large of a move up in such a short amount of time is something that has only occurred 6 times on the S&P 500 over the last 40 years. Some of these marking the beginning of large moves up in the stock market, but some of these extreme rallies happened right before large peaks in the market, like 1999 and 1987. We also saw a 30% rally in 30 weeks back in 1929, right before the most historical drawdown on the US stock market in modern financial history. But one particularity about the market strength that we've seen today is how few stocks have actually been moving higher with the S&P 500. Since March of 2024, the S&P 500 index is up significantly, while the average stock on the S&P 500 has actually declined during that period, suggesting only a handful of stocks have actually been pushing the index higher. The top 7 stocks of the S&P 500 returned on average around 140% since the start of 2023, while the other 493 stocks in the S&P 500 haven't even risen by 20% over that same time period. So the question is whether the rally we've seen today is actually comparable to the strong rallies we've seen over the last 40 years that led to additional upside in the years that followed, or whether the weak participation that we're seeing in 2024 makes today's fantastic rally more similar to 1999, 1987, or even 1929, all instances that were followed by large market drawdowns. Let's start by looking at the 4 healthy rallies that actually led to the stock market continuing to move higher over the next year, and that's 2020, 2009, 1986, and 1982. Starting with the 2020 30% rally, the stock market made an incredible V-shaped recovery in 2020. And when we look at the number of stocks that were moving higher during that V-shaped recovery, we get a clear answer. This line, called the advanced decline line, measures the number of stocks within the New York Stock Exchange that are moving higher or lower over time. And in 2020, you can see this advanced decline line was moving significantly higher. In June of 2020, the advanced decline line actually made a new all-time high, while the stock market was still below its all-time high. That was suggesting there were a lot of stocks participating in that rally, and it wasn't yet fully reflected in the price. When we rewind to 2009 with this 30% rally, we actually saw the exact same thing. The advanced decline line made a new all-time high, despite the fact that the stock market was still significantly lower than its 2007 high. Rewind to 1986, and we see the same thing happening again. A very strong 30% stock market rally with the advanced decline line moving substantially higher, showing a broad participation of many stocks. This provided the foundation for the market to continue moving higher for at least another year. And again, in 1982, this huge stock market rally that occurred back then was also supported by a large number of stocks pushing the index higher. The advanced decline line moved to the highest level in over 5 years. So zooming out, it's safe to say that all of these similar strong rallies that we've seen throughout history that actually led to the market moving higher afterwards had many stocks participating in them. But now let's take a quick look at the 2 rallies that led to a substantial market peak in the few months that followed. So that's 1999, 1987, and we're also going to take a look at this rally that occurred in 1929. Starting with 1999, while the stock market was showing incredible strength, when we look at the advanced decline line, it was actually showing that more stocks were moving lower that year. So we had a clear weakness in the number of stocks participating in 1999, despite the market moving higher, which weakened the foundation of the stock market rally, eventually leading to the large market peak in 2000, which was followed by a vicious bear market lasting 3 years and seeing the S&P 500 drop by 50%. When we rewind to 1987, we see a similar situation. The stock market was experiencing incredible strength in the 2 years prior. As we just saw earlier in the video, in 1986, the number of stocks that were moving higher was very strong, but we can see in 1987, while the stock market continued to print record gains, the advanced decline line leveled off, suggesting less stocks were actually moving higher. In fact, in August of 1987, despite the S&P 500 going on a true melt-up, we see the advanced decline line was actually lower than it was just a few months prior. Yet again, this was a sign of a lack of participation in that market rally, which set the stage up for the violent 35% pullback we saw in the S&P 500, retracing all of the gains that the stock market had made in 1987 and then some. When we rewind to 1929, we see the exact same situation. A very strong rally with a reasonable amount of participation in 1926 and 1927, and starting in mid-1928, we start to see the stock market go on a massive melt up, with actually the number of stocks participating in that rally going down, yet again setting the stage up for the large market peak that occurred in 1929. So we've taken a look at 7 exceptional rallies. 4 of them saw large participation, which all led to further upside in stocks. 3 of them saw weak participation, all of them leading to significant market peaks. So with the S&P 500 posting a 30% gain over the last 30 weeks, what does the participation of stocks look like today in 2024 relative to all of these examples? Well, when we look at the advanced decline line, it actually doesn't look that bad. It made a new high in May of 2024, suggesting that a lot of stocks have actually been moving higher throughout 2024. Now, there's been a little bit of weakness in the advanced decline line more recently, but it's nothing alarming yet. Now, how does this make any sense when we hear headlines about the fact that 34% of the S&P 500's performance in 2024 has been a result of NVIDIA? Well, it does seem that a handful of stocks are pushing the S&P 500 to extreme heights, but the rest of the stock market isn't necessarily weakening like in 1999, 1987, or 1929. The best way to illustrate this is by looking at the RSP, which is the equal-weighted S&P 500 ETF, which removes any outside contributions from the large cap tech stocks. Now, yes, it has been underperforming the S&P 500 over the last few months, but when we look at its general structure, it's not in a bearish posture by any means. Price broke out of a key resistance level in early 2024 and recently has been just retesting key moving averages. Now, again, this could all change very quickly with the RSP beginning to roll over and the S&P 500 continuing to move higher over the next few months. That would start to look more like 1999, 1987, or 1929. But as things currently stand, we don't want to be flipping bearish on this market too early. The technicals look strong, and contrary to popular belief, the participation of stocks isn't that weak. We did recently close our long positions on the technology sector and on Indian stocks to rebalance our portfolio a little bit, and we increased our short exposure on a couple of stocks that we do think that could have severe market downside, even if the market continues to move higher here. If you want to have access to all of our trades, sign up to our website and join our fantastic community of traders.